I think it is sustainable. I think that what's clearly going on here is that the economy is slowing. I think there's talk about the jobs report. Is that a coincident indicator? Is it a lagging indicator? I think it's more of a lagging indicator. There's just too many stresses on the economy right now. Housing is weakening. We're seeing in our credit card data that gas prices, gas spending is crowding out other spending. You're seeing the high yield spreads blow out. This is sort of classic, slowing of an economy, and the 10-year is weakening, and the correlation between growth and value and the 10-year yields has been extremely strong, especially of late. And when you think about what you want to own going forward into a weakening economy, it's these companies with skinny balance sheets, with pricing power, companies that don't have a lot of operating leverage. And thus far, what we're hearing from our growth companies is business is holding up pretty well. Enterprise IT spending remains strong, maybe a little bit of deal slippage. Healthcare has obviously been resilient. Consumer internet, there's going to be ad weakness, obviously. There's a post-pandemic reversion of some of the spend there. But valuations have contracted so dramatically. So I think the outlook for growth really is improving.
Yeah, there was a lot in your answer there, specifically about rates. When you said rates have been coming down, they were, and
right.
Now they look like they may have some steam again to the upside. If that's the case, as you said, they've been so closely tied with the performance of technology stocks. Isn't that a problem?
I think it would be a problem, but I just think it's very unlikely to be the case. You're already starting to get somewhat of an inverted yield curve. I think that's likely to play out over time. And then people are just going to sort of shift into the safety of growth. And as we get into these earnings reports, I think they're going to be a lot more challenging for value companies than they are going to be for growth companies.
What if they're just challenging for everybody, right? As you just heard the conversation
Sure.
we had, there are a multitude of issues you need to worry about, whether it's demand, enterprise spend, and then now we have the strongest dollar that we've seen in an awfully long time versus some currencies, and that's a major issue, particularly for the companies you're talking about.
Yeah, and I think that's a good segue into where we're finding interesting opportunities. So obviously, healthcare has been a massive leader. It's basically been energy, staples, utilities, and healthcare, but it's really been the big uglies of healthcare, right? It's been big pharma, it's been insurance companies. If you think about the small and mid-cap growth space within healthcare, they've been decimated just like every other growth company. Yet their business backdrop is it's resilient, right? It's healthcare. And so we think there's a lot of interesting stocks down here which could outperform in a variety of different environments, but particularly one where the economy slows and rates start to drift lower.
Let's go through a few names in the time that we have left. Arrowhead Pharma is one, ARWR. It's down greater than 50% from its high.
Yeah, exactly. So the XBI has had the Biotech index has had a historic move down over 50%. Arrowhead's a little bit better than that, but not much. Fantastic business. They're basically the opposite of what Moderna does. They do RNA interference. They can knock down all sorts of bad proteins. They have an enormous pipeline, a pipeline that rivals Alnylam, which is about 4 times their size. We think they're getting pretty close to having a drug on the market, and then that will result in a pretty big re-rating of the company.
And Dexcom's another, also down greater than 50% from its high.
Sure. Dexcom is a high-quality growth name. Their total addressable market is about to, potentially 10x. Historically, they do continuous glucose monitoring for diabetics. They've changed the lives for diabetics. But a recent journal article in the New England Journal of Medicine basically showed that for non-insulin intensive patients, just having awareness of your glucose levels results in improvement in your A1C levels and better outcome. So there's 3 million type 1 and type 2 insulin intensive patients in the US. There's 27 million type 2 diabetics that don't take insulin and could benefit from having this therapy.
Lastly, tell me about Axonics, because as I look at it, it's certainly performed far better than many other stocks in the market. It is a positive year to date by 13%, which is no slouch. And anything positive seems like a huge win now.
Yeah, Axonics is obviously the exception here, despite really negative experience of small and mid-cap growth space. But it's a really transformative technology. It's for women to address retention, incontinence issues. It's sacral neuromodulation. Historically, this has required a surgery every 3 to 5 years. Their technology enables you to have one every 15 years. For a while, you needed to recharge it. You no longer have to do it. They just launched a direct-to-consumer campaign that we think is accelerating their business. We can see this in Google Trends data. We can see it in their web traffic. So we're pretty encouraged there.
All right. It's good to talk to you, Jason. I'll talk to you soon. That's Jason Tauber, Neuberger Berman.